All right, the moment that you've all been waiting for, I'm going to break down how I trade the three-line strike and how you could possibly improve on your three-line strike trading. The goal of this video is not to give you a rules-based strategy like everything else, but give you a better concept of why I use the three-line strike and why I think it's so good in regards to trading it as you would trade price action. So there are a lot of discrepancies and specific scenarios that I want to run over. And I also want to go over every single one of my trades so far in Strategy Wars and let you know my thought process behind my entries, why I closed early, and why most of them have played out. What I would like to do first is actually discuss the most important of the three moving averages that I have in my strategy, the 50 smoothed moving average. As most of you already know, I like to use the 21 and the 200 as well as the 50. And originally when I made my videos on YouTube about this, I wanted price to be trading above or below all three of these in order for you to take a good, successful, momentum-moving trade. But as time goes by, I realized that I'm missing out on a lot of trades by waiting for those confluences, and once I do get into those trades, they are very short-lived. Whereas if I only focus on the 50, I can get some pretty decent moves above as well as below instead of waiting for the 21, the 50, and the 200 to line up. I could just use this as my confluence of buy above and sell below. So this is the primary thing I'm looking at when I'm choosing my direction for my trade. But again, a lot of my entries are subjective and what I'm seeing as well as price action. So it's not a guaranteed rule that you need to have in order to take the trade. Now, if we add on the 21, if the 50 is the buy above or sell below line, the 21 shows us how strong that move is. If price is rejecting off of the 21 moving average, that means the momentum is very strong in that direction. So as you see price start crossing the 21, you know that you are losing strength as it slowly starts to go the opposite direction. Strong rejections, breaks through. Strong rejections, breaks through. These periods really suck when it comes to scalping this because you will be stuck in trades for long periods of time. Now, you may be wondering, what about the 200? Well, let's put it up, and I'm going to do my best to explain why I think the 200 is and should be looked at as a support and resistance level. As price starts losing momentum and not rejecting off of the 21 anymore, meaning it's lost momentum, and is most likely going to go back to its previous level of support and resistance, which the 200 seems to be the magnet for that. As price starts crossing those moving averages, you see it really wants to get to the 200. Then if it doesn't reject to continue, it will break that 200 and use that 200 as its new support. This is why I was always saying before, sell below the 200, buy above the 200. Because if you guys are familiar with price action, this is a perfect break and retest. So what I would like to convey the most to you is that the three-line strike strategy is a price action trading strategy. So what you are looking for is market structure and support and resistance levels. You are using the 200 as a known level of support and resistance across multiple time frames, and the 21 and the 50 are going to be your market structure. So as you see all the moving averages line up, you see that the momentum is in that direction as price correlates likewise. Then you see the price pull back to the 21. As price rejects the 21 and continues, you have now created a piece of market structure. And as price breaks past that previous low point, when it does come back, if it does reject, you know for sure that this is now market structure. Market structure, for those of you that do not know, which you should if you've gone through all the coursework, is higher highs and higher lows, or conversely, lower lows and lower highs. Breaks and retests of these levels are going to be your perfect entries, especially when they are in confluence with the 21 moving average. Like we saw right here, a break above and a retest rejecting off of the 21. The issue that you always need to keep in mind when doing this is not the fact that price will continue up and down and break and retest and continue. Every single time you get a break and a retest, you should always be concerned that this will become a double top or a double bottom. So if we toss up the 3-line strike indicator, knowing all of those things that you now know, we got a rejection off of the 21 with a 3-line strike. You can take this trade entry and always keep an eye out on this level. If it rejects off of this level aggressively, you get out because it's probably going to be a double bottom. So when looking for long or short positions, make sure that your take profit fits within that range. What I want you guys to stick to is a 10 pip stop loss and a 20 pip take profit. If you cannot minimum get this out of your trade, you do not take the trade. And because you know that there's a potential for a double bottom, this trade is absolutely valid, and you can actually hold it for a little bit longer trying to get that double bottom trade. Or if you want to trailing stop loss as it breaks that range, you can continue holding that trade, and once it breaks through that area, your new stop loss is above this low point right here. So your stop loss would be above here, because if it breaks through that, it is invalidating the market structure. So as it comes back to that point and rejects again with another 3-line strike, your new stop loss is exactly at the end of this wick. And if the market structure continued, you could keep moving your stop loss to the next swing high, which was the previous swing low. Staircase patterns. These are always going to be your new stop losses if you want to hold trades longer. If you just want to do the scalp and get out of the market and get your money, stick to a specific risk and reward. 1 to 2, 10 pip stop loss, 20 pip take profit. Now, you might be saying to yourself, Artie, that's cool and all, but is there any way to tell when this market structure is going to stop and a potential double bottom is going to get there? Well, that's a really good question, and I have an answer. It's called divergences. So this is the exact same thing we were just looking at, just on a 5-minute time frame. Before we were looking at a 15-minute. So we have our low point here, then we have our low point here. But if we focus on this area right here, we can see where this pullback to that previous support level will potentially be. And we do that by spotting divergences. So lower lows on price action in a downtrend and higher lows on the RSI. These are usually a good indication that the price is going to pull back. Then as price continues down, but the RSI keeps floating up and doesn't seem to want to drop below that previous point, you kind of have a great indication that the likelihood of that trade continuing in that direction is not good. Now, you're not looking for full reversals at this point because those happen once in a blue moon, but you now know that a period of consolidation and or a retracement to a Fibonacci level is likely. So when people ask me about what indicators I use, I have the MACD standard settings and I have the RSI standard settings, minus I've changed my style to this where it's just a solid yellow line with no upper and lower bands, and one line in the middle at the 50. So when I use oscillators, I'm only using them for divergences. So you can see we had a divergence on the MACD as well as a divergence on the RSI. So that means if you were holding this trade down here and you were getting all of these signals of divergences, would have been a good area to take profit. Now, what I would like you guys to focus on is a higher time frame, because what I've been seeing lately is that when trading with the trend, the 15-minute 3-line strike signals are way, way better. Price above the 50, 3-line strike signals. Price below the 50, 3-line strike signals. Price goes down. Again, don't take every single one of these because that's foolish. What you're looking for is price action. So after yesterday's news spike where we had this 111 pip candle, you can see that here was a rejection point. So taking it down to a lower time frame, it probably looked like this. There we go. Now, if that's your rejection point, drawing boxes on there and price comes down to retest that area, and then you get your 3-line strike on the 15-minute time frame, and depending on the size of the candle, you could have gotten a nice move up. But also keep in mind that on higher time frames, you should still focus on the swing low being your stop loss. So in this case, let's see if it would fit. No, a 10 pip stop loss would have gotten stopped out. But if you went to the swing low, which is 24 pips, going for a 1 to 2, you would have got it. Which is great because your exit signal was an additional 3-line strike. And if you look closely, you can see that we had a higher high and a higher high, and on the RSI, we had lower highs. Divergences on 15-minute time frames are much more substantial, but they usually start with a divergence on a lower time frame. So that's pretty much everything that you need to know about why I use these moving averages, why I use oscillators, and how market structure and support and resistance levels work. If you want to actually mark up support and resistance levels, what you want to do is go on a higher time frame. So for example, you can see clearly on a 1-hour time frame that we had one rejection here, another rejection here, and then as price came back to this zone, it kept rejecting off of these areas. But it's not really necessary to do these boxes for support and resistance levels because, like I said earlier, if you look at the 200, it's pretty much the exact same thing as that. Rejecting off of the 200, which is also that zone. Now again, it's not an exact number that it's going to reject off of, but it gives you a nice cushion for stop losses. Now, as most of you guys know, I am doing the 20 pip challenge for this season, and after today's losses, I am done with level 5 and working again on level 6. So let's go through my trades and I will try to do my best to explain why I entered and how the trades played out. So this was day 1 of Strategy Wars. As you can see, I had a level of support and resistance marked up here, which also coincided with the 200. And then price came down and rejected off of the VWAP line, which I have occasionally, just so that I have more areas like the 21, the 50, the VWAP line, the 200, support and resistance levels. So if price rejects off of any one of those, and that rejection is in the direction that I want to take the trade, I will take that trade. So we got a rejection off of the VWAP line. And for me, this was a 3-line strike because for me, this is a doji and then an engulfing candle. So I took this 20 pip take profit, 10 pip stop loss. Once price started to come back, it rejected with an additional 3-line strike off of the 21 and the 50 moving average. So I got into a second position. I stacked this trade. This pullback was also a Fibonacci retracement. So if you draw your Fibonacci tool from this wick to this wick, this was a perfect gold zone Fibonacci retracement. And as price got up to that previous high, it showed no resistance whatsoever and continued straight through it. So this is now my level of support. As price came down, rejected this area, I got in on another trade. At this point, trade number 1 has already taken profit. Trade 2 was still in play, and I entered into trade 3. And once price came up and we got a rejection at this double top with this 3-line strike right here, I closed the second and third trades as I saw a double top and Frankfurt session was about to open and I didn't want to risk it. So 3 successful trades because all of them were in profit. One of them hit my profit target. The other 2 I had to close early. Now, day 2, price was starting to come down, and as you can see, I have some Fibonacci levels here, so that means that price was coming up until this point right here, and as price started to come down, I was looking at a Fibonacci gold zone level for a rejection and my trade entry, which coincidentally added to my levels of confluence because that was also the 200 and the 50 period moving average. So I got my 3-line strike, entered into my trade, started to ride the wave up, and got out of my trade early as it rejected and created a double top. So once we got this rejection, I got out right there. Still closed the trade in profit. Day 3 was 1 win and 1 loss. The loss was because I saw a rejection and 3-line strike as well as a divergence, assuming that maybe it might just be a little liquidity grab as price continues up and then breaking through the 200. Once it rejected, and usually what I do with risky trades like this is enter my trade with a 10 pip stop loss and a 20 pip take profit. And as price starts going in my direction, I immediately move my stop loss to the absolute 1 pip below that wick. So I immediately got stopped out once I saw it rejecting off of the 21. As price kept coming down, I moved the chart to a higher time frame. This is a 1-hour chart, and we got a very, very large 1-hour 3-line strike. So I entered in the trade there, and it immediately played out. Now, day 4 was a bad day for me. I kept trying to catch the top of the market and ride the wave down. These counter trend trades are very, very risky. The reason I entered these trades was because I saw a divergence from this high to this high, and so I took the trade off of this support and resistance level that I had drawn up, which was the previous swing high. Got stopped out on this one. Then I got a 3-line strike on Heiken Ashi candles, rejecting off of the VWAP line. Got in again and got stopped out. Then got another 3-line strike on 1-minute Heiken Ashi candles. Got in again, kept holding this trade. Then we got a 3-line strike on the 1-minute chart, so I got into another trade to recuperate my 2 back-to-back losses. Got stopped out immediately, but then got an additional 3-line strike on the 30-second time frame, rejecting off of the 21, so I got in again. And then as price came back up here, this is where it hit my trailing stop loss of this previous trade. So this one closed here, and then this one got stopped out with this huge candle, which came unexpectedly because it was not even Frankfurt open. But due to that, we got that double bottom. So I started looking for long positions, entered in a 3-line strike on the 30-second chart, twice stacking my trades to try to recuperate some of the losses from the day, came back turned against me and hit my stop loss. And then again, tried to get in on this support and resistance line with a 1-minute 3-line strike. And essentially, I just got stuck in a period of consolidation and got cooked. These are prime examples of what you don't want to do. What I should have done was follow my rule of stop trading after 2 back-to-back losses. I keep breaking that rule, and I don't know why. Looking back at this, I see every single one of my mistakes. You can see the high was formed here. We broke out of that, rejected it, creating market structure to the upside. But I kept trying to catch the reversal. My bias got in the way. Day 4, price made a divergence right here on the 15-minute time frame, and as price came up a little bit, this was a perfect Fibonacci retracement of this down move, so I tried to take a short position here, ended up getting stopped out as price decided to make a third divergence. So these two were a divergence, and then this one added on top of it. So the RSI made a high, a lower high, and a lower high. And at this point on the 15-minute time frame, I got into my trade. And because my account had been so trashed from day 4 of trading, I decided to risk it to get the biscuit and stacked many trades on top of one another, and then the market closed on me. My price target was this previous wick right here, as you can see labeled on my chart and my analysis. And as market opened on Monday, all of my trades closed in profit, bringing back my account into profit and getting me on the right track to completing the 20 pip challenge. Next day of trading, you can clearly see that this is an area of resistance. Price is not liking this level, So as price started to break through the 21, I figured I can get a nice reversal trade towards the 200 as long as it fits in my 10 pip stop loss and my 20 pip take profit. So we ended up getting a 3-line strike rejection off of the 21 on a 15-minute time frame. I ended up getting in a little bit late because I was in the bathroom at this time. So I got in at the close of the next candle and ended up closing this trade early at what the original take profit should have been. So if this was my entry at the close of this candle, the take profit of 20 pips would have been down here. And so I just got out early because I was in profit and I wanted my point for the day. Now we are on day 7 of the 20 pip challenge and strategy wars. So previously price was on an uptrend, but the short-term downtrend and or retracement ended up breaking out of that and then breaking through this structure that it made. This low, this low, this low, this low. All of this was a support level. As price broke down and retested it, I kept watching, looking for my entries, and then I saw a monstrous divergence on the 5-minute time frame right here and right here. So this is a 1-minute chart, but on the 5-minute chart, this was a massive, massive 3-line strike. So I got into the trade with a 10 pip stop loss and a 20 pip take profit. And as price started to go in my direction, price rejected twice off of the same level at 0.6500, which is an even bank level, psychological level. Price kept coming down. I didn't anticipate it coming back up, so I ended up closing my trade early, which was still in profit. The reason I have my volume profiles on here is because when I'm unsure about a trade, due to the break in market structure right here, we had higher highs and higher lows until it made a new lower low here, breaking market structure. Popped up my volume profiles to see if there was anything fishy here. I saw big bearish volume right here, and then the point of control for both bearish and bullish was right here. Didn't want to have anything to do with this trade in case the bearish volume took it to my stop loss. And as you guys can tell right here, there's a big orange box, and that is an area of consolidation that price has been in for quite a while, and I didn't like anything about this trade. Just to let you know, price did actually go up to this area and hit my original take profit. But I have no regrets because I closed my trade in profit and I was happy. Now, day 8, we are looking at the 15-minute time frame and getting a huge 15-minute 3-line strike, rejecting pretty close to the 21. So I felt comfortable about this trade, entered, price started to go against me, and as it rejected here, I knew that we were playing in this wedge. So we got a huge 15-minute 3-line strike, bearish engulfing candle. I got into my trade, and then as price started to go against me, I drew up a Fibonacci tool off the high and low of this candle, and it rejected off of the Fibonacci gold zone, the 618 and the 0.5. So I ended up getting into another trade as it rejected that gold zone, and then price went straight against me. I was very concerned about this, assuming that both of my trades would hit stop loss. Both trade stop loss were at this level right here. And then luckily I got a huge bearish candle right here, and it kept continuing down. I ended up closing both trades at a 1-to-1 risk to reward ratio because both trades together would have been the equivalent of a 1-to-2, as you can see in my little typing right here, which also caused me to complete level 6 of the 20 pip challenge. Now, let's go into current market day. Today is day 9 of the strategy wars and my journey of my 20 pip challenge. I got onto the charts right about 5:30ish, so right about this area. Sorry, I just changed charts to the one I actually trade, which is Oanda because it's the closest price to Osprey. So essentially what I was looking at, I made some markups. This box goes all the way left because that was a previous high point. We hit it, we rejected, we break through, we retested. That is now market structure. We break through, we come back, we retest it, came back, reject. I assumed that this would be the new market structure, and so I started looking for longs. We got a 3-line strike here on the 5-minute chart. I marked up this trade, but did not enter it, even though Everything was fine. Market structure was fine. Everything was fine. It rejected off of the 21. It was literally the perfect setup. But the one thing that messed me up was the fact that this, from a news event, was a 111 pip candle. I could not get this out of my brain when I was analyzing the charts. This was the red flag on a date type of scenario. That trade ended out instantly playing out, and I regretted not taking it. So instead of winning today, what I decided to do was go down to the 1 minute chart and take this entry here on this 3-line strike, setting my stop loss at 10 pips and my take profit at 20 pips. But what I ended up doing was moving my stop loss to just above that candle, and then this wick stopped me out. Price continued down, so I got in on another entry at my same price as I entered before. Price started to come down, I was in profit, and then price went against me. I closed this trade right about here because it was the exact number that I needed to be on level 5 of the 20 pip challenge. So 74.26 needed to be my profit area or my account balance. And as you can see right here, I am currently $74.37 in profit on the 20 pip challenge. So after taking 2 back-to-back losses, I decided that I need to follow my damn rules and not take any more trades. Even though I kept watching the charts and I saw this 3-line strike pop up on the 1 minute chart, and then when I looked at my oscillators, I saw a clear and concise high point and a lower high. A high and a higher high. This, my friends, was a perfect divergence and the trade that I should have waited for, but I didn't. This is a 10 pip stop loss and this is a 20 pip take profit, and it immediately hit that. Again, counter trend trade, but it is what it is. I found it quite funny that price rejected right here at the 0.666 level. I knew the devil had to play his hand in my day trading today. So I had 2 back-to-back losses today, so I am currently done with level 5, going to try again for level 6. I really hope that gave you guys a nice insight into how I trade price action in accordance with the 3-line strike, because the 3-line strike is an amazing price action candle formation. Just a few things before we wrap up. What I would like to do is give you my Fibonacci settings. These are all the levels that I have, and this is why my Fibonacci looks like my Fibonacci looks. Remember that when price makes one solid move up and starts rejecting, what you should do is draw a Fibonacci tool from the bottom to the top of that and wait for a gold zone rejection, which happened perfectly right here. You could have gotten into another trade and carried this thing up. Again, always anticipating a double top or a double bottom to not get stuck in periods of consolidation. So you guys got it? I know this chart looks a little bit messy, but if you squint your eyes, you can see it. Level of resistance, breaks through, uses it as support, and makes market structure. Higher highs and higher lows. As price starts coming back, even though it's in a downtrend, draw a Fibonacci tool and look for gold zone rejections, which if you look at it is also a part of this structure. This resistance now became support. It's all market structure. It's all price action. These little peaches and eggplants are just giving you the better entries for these price points. Lower time frames are less consistent and reliable. Higher time frame 3-line strikes are much more consistent and reliable. A break, a retest, and a rejection. Enter. A new high was formed. Look for divergences. Price started to come down. This previous resistance, now support level. It's all price action. It's all a staircase. Higher time frame signals are much better. But if you want the laser entries, you can go down and risk it on the lower time frame, but don't go down to the 30-second like I did, because that was a mistake. If you lose 2 trades in a row and you have a tendency to revenge trade, don't continue to trade. Currently, if you're looking for anything on AU right now, we did break that previous point. We came down to retest it, and now we're going up. So again, market structure. And my price target on this current move up is 0.67136, because if you look on a higher time frame, all the way back here to the left, this is the area that it used as support and then broke through using it as resistance. So this is the inefficiency in the market that I'm seeing. So yeah, anyway, I know this was a long video, but I love you guys and I wanted to give you all the information that I possibly could on the 3-line strike. Thanks for watching and we'll see you in the next one.